Morning, everybody. Not welcome to a new trading week, but welcome to the start of our trading week, I guess, unless you've been trading Monday, Tuesday, which I have to say I have not. Morning, Jeffrey. Hi, everybody. Morning. Wow. Well, I don't know whether Adrian showed you some of the sort of longer-term charts. I've just got my eclectic mix of instruments here that I'm going to put the daily on just to show you what's going on. And I know that Adrian referred a little bit to the daily charts. Are we bottoming? You'd wonder why we'd be bottoming with all this appalling news around, but certainly dollar-euro, that's the top middle chart. Possibly bottoming there, but it's still a bit early days just yet to make any assumptions there. Euro sterling, well, with the appalling manufacturing data last week in the UK, it wouldn't be surprising to see that reverse, and it certainly has been showing signs over the last couple of weeks anyway. This sort of 80 level was a pretty tough nut to crack. Gold, we've talked about already. Adrian's talked about that. Gold is... a very sweet agent to say that he's never seen it so quiet. He needs to go back 30 years when I started trading it. A big range on the day would be a $2 range. So believe you me, it can be a lot quiet. In percentage terms, I guess. I know what he means. Okay, news and what's going on. Well, last week, I've just put the calendar up here. Last week, FTSE, Dow, stock indices all a lot lower. I think FTSE actually closed on its lows for the week, although I think ahead of a long Jubilee weekend, it probably wasn't surprising. There's quite a bit of, sort of book squaring, as it's called, ahead of the weekend. China looks like showed more signs of a slowdown. The US, well, we know how absolutely appalling that NFP, the non-farm payroll data on Friday was. Very, very disappointing. Plus downward revisions of past data. So, this is really painting a picture of a very sort of anemic growth path, which is not really what the global economy needs. Europe, well, what do I need to say? We know all about Greece. We know about Spain. Here's this article in the FT that I've just got showing you on the screen about the Spanish authorities making a plea for bank aid. I'll go into that in a little more detail. We had surveys. Remember the IFO or IFO and ZEW, the German business and economic sentiment indicators, are all weakening. The UK, wow. Well, very poor manufacturing data, as I said a couple of minutes ago, and it looks like that's certainly pointing to a deeper recession than first thought. Admittedly, manufacturing is not a big part of what we do in the UK anymore, but it still is important, and to have that number falling off the edge of a cliff like it has done is a little bit worrying there. So, in summary, really no economy is escaping the turmoil that really is emanating from the Eurozone. We've discussed the US, China, Europe, the core engine for growth in Europe, Germany, the UK, all looking pretty dire. So this week we've got a lot of data out, a lot of events. I know we're already in Wednesday, so, we're sort of... certainly 2/5 of the way through the week, but it's important that we just make sure that we're prepared for what is to come. Already, we've had some data out. We've got central banks really this week. In fact, I added them up. I think we've got 4 central banks making interest rate decisions. We've already had Monday and Tuesday out the way. So the ones we've already had are the Australian rate decision, which was overnight. They've actually cut interest rates by 0.25% for all of those of you who are trading the Aussie dollar. The Canadian rate decision was yesterday. That's actually unchanged. So no change in the Canadian rate. But you will see certainly some of the data that came out yesterday underscores what I've been saying about these sort of German business and economic sentiments that are weakening. We've seen the factory orders in Germany, German factory orders falling 1.9%, more than the anticipated 1%. We've seen retail sales across Europe expected flat to sort of down a little bit, down 1%. So that was weaker than expected as well. So data continues to disappoint. For the rest of the week, well, we've got the key interest rate decision today. Please note that the ECB, their interest rate decision day is today. It's normally on a Thursday, but it's actually on Wednesday this week. So today at 11, let me just highlight this for you. We have the minimum bid rate comes out at 1:45 our time. I suspect we will have no change, although there are rumours of a cut. The money market's pricing in the possibility of a cut, but I got a funny feeling that the ECB may wait for further developments on the Eurozone crisis, Spain in particular, etc. So I think on balance it's likely that we'll not get anything from the ECB. But please ensure that you set your clock 1:45. Do not be in the middle of something. Don't start to put a position on just before this data comes out. Always best, key data like this, it's best to be flat going into it, please. Okay, Thursday. Now, I'm just going to focus on the key events. There's a lot of data out, and I'm sure you can drill down on this, but these are the key ones. Thursday, we have our UK rate decision. So that comes out at midday, the official rate. There are rumours of a cut, but I think it's unlikely. The Bank of England has announced that they're not going to raise rates until late 2013. Are they going to cut them? I think it's very, very unlikely. I think the focus again is going to be on the quantitative easing, or what's called the asset purchase facility, where they effectively are printing money. There is a 50-50 chance, I'd say, that they're going to introduce more quantitative easing, but it's not altogether certain at the moment. I know that Mervyn King, the governor of the Bank of England, has expressed a lot of worry about the Eurozone crisis on the impact, I should say, of the Eurozone crisis on the UK economy. Ironically, it is the crisis in Europe that has helped British yields, that's the yield on our 10-year bonds, fall substantially, and there is incredible benefit to the UK Treasury being able to borrow money at considerably lower rates than certainly the peripheral countries are. The yield on our 10-year bonds are sort of a near 1.8%. Just imagine if you're having to refinance all your borrowings at 6.5%, like Spain and Italy. There's massive cost implications there, of course. Okay, so that is what's happening on the interest rate decision. We've also got Ben Bernanke testifying. Now, this chap, Ben Bernanke, he is chairman of the U.S. Federal Reserve. That is the central bank in the U.S. That's equivalent to our Bank of England, equivalent to the Eurozone's European Central Bank, or ECB. So that is an important event at 2, I think it's at 3 o'clock, in fact. Yes, I've got 2 o'clock down here. It's actually at 3 o'clock. He testifies before the House Financial Services Committee, and it's a sort of a semi-annual thing about monetary policy. So this is key. This is really, really key. What happens is they tend to release the text of his speech literally at 3 o'clock. So the market could go absolutely nuts at 3 o'clock, especially if there's any strong hint from Ben Bernanke that there's going to be further quantitative easing measures. But that is an important event, please. So really watch out for that. That's 3 o'clock on Thursday afternoon. Other than that, lots of other bits of data that aren't quite so important, and because there is so much, I'm just focusing on the key stuff. The most important stuff, really, before the end of the week, is probably the U.S. trade balance on Friday at 1:30. Obviously, a poorly an increasing trade balance, i.e. where the US is sucking in more imports, whilst it actually could be perceived to be dollar negative. In fact, some quarters you could take a little bit of encouragement from it that the US consumer is still consuming, and that's something that the market is particularly sensitive to, consumer sentiment numbers, etc. But that bit of data comes out looking for a deficit of close to a sort of 50 billion there. As I say, with all data, remember, it's not how good or bad the number is in terms of what you may think, it's how it is compared to what the market was expecting. Remember, markets price in data. The markets will know what they're looking for and will be positioned accordingly. If a bit of data comes out, it's bad, but not as bad as the market expected, often the markets will react positively. So that's the summary of what's going on. The other key bits of information that are happening at the moment, you've all heard about it. Spain, banking crisis, bank downgrades, two further downgrades for Spanish banks. What Spain is wanting is for the Spanish banks to get help directly from the ECB. This is not allowed under the rules. The rules state that the ECB cannot help individual banks. It can only help individual countries. So Spain has to get help from the ECB, and I think that's the big problem. They don't want to be seen to be having to tap the markets for support and help from the ECB and the IMF. But the problem is the Germans are stickler for rules, and they are insisting that any help is provided to the sovereign nation Spain, and then the Spanish government then helps its own banks rather than the ECB directly helping the banks, which I have to say makes a lot of sense, because the counterparty to the assistance as far as the ECB is concerned is the Spanish government, a sovereign nation, as opposed to a commercial bank. The fact of the matter is, Spain has got money to survive, but it does, it's getting more and more critical. It could probably last another 3 or 4 months, but time is running out for Spain, and it really has to make some key decisions. And as we know, a lot of this is all brinkmanship between the Germans and the peripheral Eurozone economies that are struggling. Ultimately, Germany has to pay for it. If it wants to keep the whole shooting match together, Germany has to pay, and that's and I'm sure there are a lot of negotiations taking on behind the scenes. Okay, so that's really what's going on. As I say, markets are, for the time being, positive. There's a little bit of backing and filling. Will the trend change? I don't know. If it does, I suspect it will be a counter-trend rally in the very longer-term downward trend within the Eurozone. But time will tell. Thanks very much for listening. Good luck with the trading for the next 2 and 3/4 days.